Is America in a recession? Well, what if I told you that it was actually in a depression for decades? Stock markets have been hitting record highs, GDP is soaring, corporate profits are through the roof, and billionaires are richer than ever. But for the average American, it feels like you're running on a treadmill, working harder but getting nowhere. And that treadmill is speeding up. Why? Because wages have come nowhere close to keeping pace. This is the silent depression, an economy that looks great on paper but is creating an extinction level event for the middle class and destroying the American dream. Let's take a look at the data. So I have a ton of data prepared, ton of charts, but before we get into the charts, I want to run through a couple facts that Americans might not be aware of. The suicide rate is at levels not seen since the Great Depression. Wealth inequality is now worse than it was during the Gilded Age of the late 1800s, when wealth inequality was so bad we named an entire era of American history after it. Well, it's actually even worse today. Drug overdose deaths are now the leading cause of death for Americans aged 18 to 45. There are over 100,000 overdose deaths per year. The overdose rate per 100,000 Americans has increased 7x going back to 1970. Combined, these suicides plus these overdose, which sociologists call deaths of despair, these deaths of despair are now the leading cause of death for Americans under the age of 35. The birth rate has collapsed and is down over 40% going back to 1970. Antidepressant prescriptions went from 1 in 100 in 1970 to 13 in 100. So that is a 13x increase in the antidepressant prescription rate. Home ownership, the median buyer in 1980 was 31 years old. That number is now 49 years old. So that is an increase of 18 years. Hours of work to buy one share of the S&P 500. This has gone from 20 hours of work in 1970 to 190 today. Put another way, the stock market has appreciated over 650% faster than the average hourly wage has. Okay, now let's look at some charts. So remember, with these relative charts, we are looking at the rate of change. We are comparing the rate of change between two metrics. Both of these metrics are going up and to the right. If you were to look at them just on their own, they're both going up and to the right. But the point here is to compare the rate of change. If GDP per capita is growing at 3% per year, well, that's great, but the average hourly wage should also be growing at 3% a year. In that case, if they are growing in line, this line would go straight sideways. It would be horizontal. For every increase in GDP per capita, you would have an increase in the average hourly wage. Therefore, they would offset. The line would go sideways. If the numerator is underperforming the denominator, you get a chart that looks like this. So hopefully that's clear. Now, for this particular metric, some people have an issue with dividing by GDP. So this is GDP per capita. This adjusts for population change. For every dollar of hourly wages, GDP per capita has grown 88% more than wages going back to 1970. Here is the average hourly wage divided by gold. But this is basically for the average hour of work in America, how many ounces of gold does that represent? Well, that number was 10 here leading into in 1970, going into the Nixon shock. That number was 10. And here in 2001, right before China was admitted into the World Trade Organization, that number was 0.06, excuse me. The number now is 0.01. It is actually the lowest on record. What this represents from 2001 up until now, your real wages or real purchasing power wages has fallen by 80% just in the past 25 years alone. Here is the average hourly wage divided by the S&P 500. Here, again, we can see the stock market has appreciated much, much, much faster than the average hourly wage. I will point out, though, that the time period where we last had political populism, you actually saw the average hourly wage increase at a faster rate than the S&P 500. So I would store that away as an interesting fact. Given where the economy might be going. Here's the average hourly wage divided by the average home price. As we can see, the average home price has run much faster. Both of these are increasing, but the average home price is increasing much faster than the average hourly wage. Or in these terms, the average hourly wage has severely underperformed the increase in home prices. This is why, part of why home affordability is so low. Here is the average hourly wage divided by corporate profits. So again, corporate profits have grown 5.6 times faster than the average hourly wage going back to 1970. Put another way, for every dollar of corporate profit, the average worker's hourly wage is now only 15% of what it was in 1970. Again, for every $1 of corporate profit. So these numbers all paint the same story. I'll put them all on so that if anyone is able to see the trend here, hopefully this is very, very, very clear. All of these numbers are down and to the right, including the birth rate. So here is just a slightly different way of calculating the same concept. So before, we're looking at average hourly wage. So this is, on average for the average hour work, how much is the average American earning? And you would expect that, for example, GDP per capita, if that's growing at 2%, you would expect the average hourly wage to also grow at 2%. This is a valid way of looking at the data, but here's another way that kind of adjusts for population change. Even when you adjust for population change, here, for example, we're going to look at total wages and salaries divided by certain things. What this is representing, total wages, is exactly what it sounds like. Every single dollar wages totaled up in the entire from every American worker in the entire U.S. economy. Well, back in 1982, for every dollar of corporate profit, workers collectively earned $8.80 in wages. Now that number is only $3.46 for every dollar of corporate profits. Here is the total wages and salaries divided by GDP. And again, it's the same story. Here is total wages and salaries divided by the net worth of the top 1%. Back in 1990, unfortunately, this net worth data only goes back to like 1990. But back in 1990, for every dollar of net worth held by the top 1%, workers earned about 54 cents of wages. Now, for every dollar of net worth owned by the top 1%, they only earn 22 cents. And finally, here is total wages and salaries divided by the total federal debt. And so what this represents, back here in the early 80s, if you totaled up every single dollar of wages in the American economy, you could actually pay off the entire national debt in under 1 year. You could pay it off 1.4 times over. Well, that number now is 0.3. What that means is it would take over 3 years of every single American working in the American economy and giving 100% of their earnings to the government. It would take every single dollar of wages totaled up. It would take 3 years of work for Americans to pay off the national debt. So here, we're going to look at it in the opposite way. So instead of looking at the average hourly wage divided by a metric, here we're going to look at the metrics we were looking at before divided by the average hourly wage. So again, remember, if the numerator is outpacing the denominator, this line will look like this. What we can see here is one of the facts that I mentioned in the intro, which is what this represents is the number of hours of work at the average job to buy one share of the S&P 500. As we can see back here in the 60s, into the early 80s, into the mid 80s, this number was basically between 15 and 25. Well, now that number is 20. So put another way, the S&P 500 has grown almost 10 times faster than the average hourly wage. That is how you get a chart that looks like this. I will also point out that really the most meteoric growth has been post-2008, post kind of ZIRP, very, very low interest rates, very easy monetary policy, record fiscal deficits. The Cantillon effect is a massively underappreciated dynamic. Here, we're going to look at the average home price divided by the average hourly wage. And again, it's the same exact chart. The average home price is running much faster than the average hourly wage. Back here, when my parents were, entering the workforce, trying to start a family, it took about 7,000 hours of work to buy the average home. Well, now it takes 16,000 hours of work to buy the average home. Here is corporate profits divided by the average hourly wage. And again, we can see, maybe this way is looking at it this way is easier way to intuitively understand the data. corporate profits have greatly outpaced average hourly wage. Again, both of these are going up, but corporate profits are growing much, much, much faster than the average hourly wage. Here is GDP per capita divided by the average hourly wage. And again, GDP, the number you will hear reported on the nightly news to tell you how great everything is, that is growing much faster than the average hourly wage, as you can see from this chart. And then finally, here's the net worth of the top 1% divided by the average hourly wage. And again, much like corporate profits, the net worth of the top 1% has greatly outpaced the average hourly wage. The back in 1990, this number was 470. That number is now 1.6. So that is over 100% increase just going back to 1990. If I was able to find data back to 1960 or 1970 or even 1980, it's actually even worse. I wasn't able to find a chart representing this. I have seen it many years ago. I saw a chart that went further back, and it's actually even worse than this if you were able to include data of the 50s, 60s, 70s. The net worth of the top 1% has outpaced the average hourly wage by even more if you go further back. So here is the average hourly wage divided by the M2 money supply. So again, when we talk about inflation, it's always important to point out inflation is a monetary phenomenon. Rising prices are only a consequence of monetary inflation. You increase the supply of dollars and you don't, you're not able to grow the goods and services at a similar rate, well, you get inflation. And so it's important to look at the money supply. If we're trying to get an accurate measure of real monetary inflation, we have to look at the money supply. Most Americans, 90-something% of Americans watching this video would agree that CPI greatly understates the real inflation rate in America. Now, unfortunately, for these two, the green and blue lines, I was able to find a component of the CPI index that measures medical costs and rents. But again, we've been over this multiple times. CPI and most of the inputs into CPI are deeply flawed metrics, and they severely understate actual inflation. But even using the government's own data, we can see that medical costs and rents have greatly outpaced the average hourly wage. College tuitions, there's no data source for this in TradingView, those have grown 10 to 15 times faster than the average hourly wage. Medical costs have grown over 100% faster than wages. And also this worker pay ratio. In 1970, the CEO to worker pay ratio was about 20 to 1. Now that CEO to worker pay ratio is 300 to 1, and that comes from the EPI. So it's not just the average worker. Here, I always try to point out that we have been trying to print our way to prosperity, print money, and just print our way to prosperity. And we are getting ever diminishing returns on that strategy. So here we're just taking a look at total GDP divided by the M2 money supply and GDP divided by government debt. Again, if we have real growth and GDP is growing, not because we're issuing a ton of debt and printing a bunch of money, but because of real actual growth, you will get something that looks like this. From 1960 going all the way to 1981, the growth rate of GDP outpaced the growth rate of government debt. But as we can see, going back to 1981, GDP has underperformed the growth rate of debt. So the government is issuing more and more debt and getting smaller and smaller return. Same thing is true if you look at GDP divided by the money supply. We were getting real growth. Where we weren't, with the amount of actual GDP, gross domestic product, aggregate economic output, that we were getting, the growth of that GDP was outpacing the growth in the money supply. But what have we seen going back to the late 90s, early 2000s? We have seen that number fall off a cliff. And I will also say that the money velocity of M2, this measures the speed and rapidity of which money is exchanging hands in the real economy, that has also plummeted and is basically in line with this particular graph. So finally, to end, Here is just a slightly different way of displaying some of these disparities. So here is one chart, or excuse me, one scale over here, and this measures the percent change going back to the start of the chart in the mid to late 60s. And so what this is showing is the M2 money supply. Again, remember, inflation is a monetary phenomenon. The money supply has grown 4,937% going back to the mid to late 60s. Well, the average hourly wage has only grown at 1,000. So put another way, the money supply, the actual money supply, has grown 5 times faster than the average hourly wage. Here is GDP. GDP has grown about 4 times faster than the average hourly wage. So, again, what good is a bunch of GDP if the average worker is not seeing any benefit from all that GDP, all that gross domestic product, all that economic output? What good is it if the average American is not seeing a coincident rise in their wages? Well, what this is showing is the money supply has grown 5 times faster than the average hourly wage, and GDP has grown 4 times faster than the average hourly wage. Here's corporate profits. This has grown more than 5 times faster than the average hourly wage going back to the mid 60s. And finally, here is the S&P 500, which has grown over 7 times faster than the average hourly wage. So this goes all the way back to the mid 60s, the last period of populism, and we can see that the S&P 500 has grown much, much, much faster than the average hourly wage. This is just a slightly different way of looking at the same data that we were looking at here. You take the S&P and divide by the average hourly wage. Over here, you're looking at basically the same data, just displayed in a different way. The S&P 500 has grown 7 times faster than the average hourly wage. So those that, in the top 1% that can afford to invest money, say in the stock market, have done exceedingly well. This is really where the K-shaped economy is. It's those who hold financial assets and those that don't. And I'll also include homes as a financial asset. I think most of us would agree they shouldn't be a financial asset, but given how hyper financialized the economy is, unfortunately they are. Just to end, I would say that with home prices, really the key with that, and why it's so critical to the American dream and building wealth, is that you are getting leveraged exposure to currency debasement. So we established that the M2 money supply is growing much faster than the average hourly wage. Well, home prices are going to go up, not because the home itself is more valuable. If anything, it's getting older as time goes on, but because there are now more dollars chasing a scarce good like housing. Now, new housing can be built, so it's not ultimately scarce. It's not like we have a finite supply and the amount of homes that we have today, that's it. Of course, it can grow, but it's relatively scarce. It costs money, takes energy to build housing, and it's a relatively scarce good. So as more dollars are printed, the price is going to go up, just like is true with gold. As more dollars can chase gold, especially if people are worried about inflation, then the gold price is going to go up. It's not because gold got more valuable. Gold is still just a shiny rock, the same as it was 1,000 years ago. A home is just a wooden box that you live in. You might see 2-3% more efficient appliances, or marginal sorts of improvements. But the reason that home prices have gone from 100,000 for the median house to 500,000 is not because homes are getting more valuable. It is because the dollar is purchasing that much less. And when you are buying a home, you are getting leverage because you are only putting, say, 10% down payment. So you are getting, leveraged exposure. The home will go up as the money is printed, as we've seen over the past 7 decades or 8 decades or 9 decades, really, the home price will go up, and you have leveraged exposure to that. You have 10x leverage. That is really the secret to why home ownership is so important in terms of the American dream. That's really all it is. You're getting leveraged exposure to currency debasement. So as the government prints more and more money, as we keep seeing, your home price will go up, and because you're leveraged to that home price by 10x, you are gaining equity on the entire home value, right? So if you only put up $20,000 on a $200,000 house, but then that house 5x's, right, to $1 million, well, you are able to take advantage of the $1 million. If you put $20,000 in, say, the S&P 500, and at 5x's, you only got $100,000 of equity. Well, if because housing is leveraged, you actually got exposure, a 10x leveraged exposure to that currency debasement, causing prices to go up. The optical illusion, and you can now tap that $1 million of equity. So you are not limited to the amount of money that you actually put into the particular good because you have that leverage. So that is why the housing story is so critical. That's why we've been covering it so much. Anyways, hopefully that was helpful. Hopefully it was not too depressing. But I think education is important. I mean, the facts that I listed at the beginning of the video, these are creating societal issues, societal strife, political polarization, all sorts of tensions and divisions and horrible things for our society. And again, I think that it all traces back to an economic story, or at least the vast majority of it does. So hopefully, examining all this data was helpful in giving context and giving color to why American society is the way that it is today. So, anyways, I will catch you on the next one, guys.